I have a very important guest, someone that knows a lot about gold, currencies. We talked about what's going on in the derivative markets, war, energy, failing economies, and really using currencies as a weapon. All of that and ever so much more coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading. And today's Coffee with Lynette, I have one of my favorite gold people on the planet, Egon von Greyerz. Now, Egon started Matterhorn Asset Management in '99 as a private investment company for high net worth individuals, pension funds, etc., all based on wealth preservation principles. So it doesn't really matter how much money you have, but Egon knows about preservation of principle. He is an educator, prolific writer, popular guest on many YouTube channels, has a phenomenal YouTube on his own. I'm so excited to have him here from beautiful Switzerland. Egon, thank you so much. With everything going on in the world today, I really appreciate your taking your time to be here.
It's a pleasure, Lynette. You're my favorite lady. I talk about these problems in the world, so I really enjoy it. I'm sure we'll have a good discussion today too.
Well, let's just kick it right off and just get right to the point, because I think that what we're seeing is the world actually starting to fall apart in Great Britain and with Credit Suisse. So can you talk about what you see happening in both those places? Because they are related, aren't they?
Yes, absolutely. And these are signs. I mean, we are at the end of an era, and one thing after the next will break, or one domino after the next will fall. And they're just the first ones. It's going to happen everywhere. We have no statesmen anywhere in the world. We have extremely weak leaders. And I don't even need to name the countries, because there isn't a strong leader anywhere. I mean, you could almost say that the only strong leader, or one of the few, would be Putin. But I mean, he's not everybody's favorite right now. So which is understandable. But in the West, there's no strong leadership, and this is what we get, Lynette, at the end of an era. When the whole system is breaking up, we get the leaders we deserve, and they are pretty awful leaders. What's happening, of course, if you take in the UK, just a change of leadership and just a new government budget that with a few, not tax changes, which weren't really that major, but they were taken the wrong way by the markets, and the UK gilt market or bond market collapsed, the pound collapsed, and the Bank of England had to come in to the extent of £65 billion to support the pensions market. And of course, today, Lynette, all markets are linked to derivatives.
Exactly.
And even the pension funds, which are supposed to look after people's most important money for their last years of their lives, and that's now also they use the derivatives market, interest derivatives, in order to create cash flow with the swap market, interest swaps, which is incredibly dangerous. So now when interest rates went up dramatically, they were illiquid, and they needed to put up more margin. And then the Bank of England had to come in and support it. It just shows how incredibly fragile the system is. And don't think that is just in the UK. This is everywhere. It's all the same. Every financial transaction in the world has got a major element of derivatives in it. All of them have interest derivatives, and some have only synthetic instruments, even if it's stock funds or bond funds, whatever it is. So, that's and the same you asked about Credit Suisse. We don't exactly know what it is, but Credit Suisse had to get support from the Fed, dollar swaps, dollar loans from the Fed, and there was about 17 banks needed. Well, we've seen 11 billion of daily swaps or financing. It's probably more, and clearly, I mean, all of that is a form also linked to derivatives. And it's not, it's not just the Swiss or the UK banking system is weak. It's the whole system which is weak. It's just that one domino falls before the next.
Egon, they intentionally make these things so complicated and complex that the normal person would go, well, I don't understand that. And so they ignore them. And this is intentional. But could you, in really simple terms for our viewers, explain a derivative and a swap? In simple terms.
Yes, in simple terms. Basically, a derivative is an artificial instrument that derives from the underlying asset. And so it's a synthetic instrument which is based real. On an underlying asset. So if you have a derivative in bonds, for example, you can just have a synthetic bonds, i.e. you're buying just a piece of paper. It's nothing to do with actually, except for the link, it hasn't got any real underlying assets with value in them. But then the most normal derivatives is interest rate. That's the biggest ones are interest rate derivatives and foreign exchange derivatives. And that's in simple terms where you buy and sell on a futures market, again, a synthetic instrument that is not linked to real money, except for when you settle it at the end of the day. Otherwise, it's just a synthetic transaction and these were used, for example, when the whole of the subprime collapse in 2008. CDOs. Exactly the same thing. So these were also derivatives that were, and assets were sold over and over again and packaged in the same derivatives. So you can multiply the actual value of the real asset by 10, 20, 100 times and trade in that. And a lot of the stock funds you're buying for the people, investors are buying, they're all derivatives. They haven't got any real shares in them either. And that's what the Bank of International Settlement in Basel, which measures these and reports these derivatives, they reduced the total outstanding about 10 years ago from 1.2 quadrillion to 600 trillion. But that was just, they just did it overnight like that, reduced. But that wasn't real. The outstanding risk, I am absolutely convinced, was still at the time 1.2 quadrillion. And I estimate, and from what I've learned also, that we are probably up over 2 quadrillion today of derivatives. So these are instruments that they're over the counter, so they're not traded on an exchange. No bank will keep the real risk element of those or the reserves against those in their balance sheet. They're kept outside the balance sheet. And this, in my view, this is actually real money that's being played with. It's just synthetic money that's not measured as money. And in my view is that this, when these problems in the world now unwind that we have been seeing, and these massive bubbles, and we saw it, for example, now with the Bank of England having to step in to save a pension fund, then these derivatives, in my view, will actually be converted from a paper instrument to real money, because central banks will have to go and support all of these derivatives because they will collapse. This whole system will collapse the derivatives and it will become debt. So instead of having, say, 2 quadrillion of derivatives, we'll have 2 quadrillion of debt as they try to save the system when the system starts collapsing. Because that's, we're on top of the 300 trillion outstanding debt in the world. There is, as I said, these 2 quadrillion derivatives. And I think a lot of that will become debt also in the next few years.
Right. And there are a few things about the derivatives and things that I've been researching and thinking about. Number one, you are right. when they changed the accounting for netting and consolidation and blah, 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 to hide the real notional value at risk, which is based on that price action. That's the problem with interest rates. They were held down, near zero for over a decade. And so all these derivative contracts built up. But now we've got this transition from LIBOR to, depending upon where you are in the world, a different interest rate benchmark. And that's coming about, unless they change it again, June of 2023. It was supposed to be 21, and then they postponed it because they ran that test on just 80 trillion, and apparently it didn't work. I mean, dead silence. So this is kind of a disease that you cannot see. But part of what I'm looking at, and I want your opinion on this as well, is, we're dealing with globally high inflation, and I'm really wondering how much of that is caused by traders trading these derivatives in, energy and food and everything. What is your thought on that?
Well, my view is that most of the inflation comes as a result of the massive increase in the money supply and thus in debt and in money printing. That's where it comes from. If you print money that no one has worked for and no one has produced anything for, it's clearly worthless money. Yeah. And then when you put that money into the system and spend that money, let's say that the whole money supply of the US is 100 billion, and then you'd print another 100 billion, and all of a sudden you haven't produced anything. So that means that everything goes up in price by 100%, because you now have 200 trillion or billion in money supply instead of 100 billion, and that money you printed is worthless, and therefore that means that you have got inflation of 100%. And in my view, that's primarily where the inflation comes from. Then we have also what happens then, of course, when there's more money chasing the same products and the same services, these will go up in price automatically because there hasn't been more produced. Right. So there'll be more money to spend, but money that's actually worth half of what it was, but nominally it's twice as much because they printed another 100%. And then that chases the same amount of goods, which inevitably just goes up by, mathematically would go up by 100%. And that, in my view, is more of the reason for inflation than actually the derivative trading.
Well, I don't know. I mean, that could be, but then a derivative is all about leverage. I mean, it's so much cheaper to buy a contract against 5,000 barrels of oil for, I think it's $145 for, to control 5,000 barrels of oil. And traders do not care. Remember, we went to negative oil.
Yeah.
Right? I mean, that had nothing really to do with supply and demand. It had to do with derivative trading. So it takes all that money that was created and then puts leverage on top of leverage. Yeah. And traders don't care about the economy. They just care about making their money, right?
No, you're right. It's derivatives are clearly a part of the money supply, but not measured in the same way. But they are measured indirectly. What you're saying which is correct. Derivatives is creating liquidity and therefore synthetic money, and that will obviously make the inflation higher, definitely.
So it boils down to a level of confidence, and we see a crisis in confidence against all of the central banks, the most obvious being the Bank of England right now. But what is your opinion on that confidence piece? Because that's what's really holding the system together. It's the public absolutely. Confidence.
Yeah. Well, So obviously, when there is political unrest, which we've seen in the UK recently, when they're changing prime ministers by the day almost, then of course, confidence evaporates. And as you rightly said, a system is all based on confidence, because it's like any market, stock market or a property market. They're not. It's market can go down by 50% by just if there's just one seller and no buyer.
Exactly.
So, and that's what confidence is all about, because it's the confidence that actually makes the market crash, not the number of transactions. And of course, we've now had, making money or investing has been such an easy game for anybody.
Yeah.
Any fool could have just thrown a dart at any stock and made money in the last 50 years, as long as they stayed in the market. And didn't get out at the bottom and get in at the top of every correction, and that's why now we have bubbles in all of these asset markets, and of course, my view is that this time it will not be possible to save it. So far, in the last 50 years, every fall in the market has been bought up by central banks by printing more money, and investors have bought the dips and never lost money. But I think it'll be different this time. We're talking about the stock markets are up, I think 50 times in the last 50 years, and debt is also up 50 times. So these markets are clearly just only up to that extent because of the printed money. If they hadn't printed or created 50 times more money, you wouldn't have seen the markets at that level. So everything is overvalued, and you can see that in dollar terms also. The dollar is, if you measure the dollar in real money, and the real money for you and I, that's gold. And if you measure the value of the dollar in gold, and if you take that, then the dollar has fallen by 98% since 1971. So take off 98% of what you've gained in the stock market and property market. That's what you've made in real terms. And that's not very much money at all. You made 2%.
Well, over 50 years. But that brings me to something else that is really troubling me. I recently did a piece on the CBDCs, central bank digital currencies. And what I discovered when I did that is that they are changing and have changed the functions and definitions of money. And I don't know if you've seen this because it's hiding in plain sight. If I hadn't done that research, I would not know this. But originally, and this is really what gold performs, the four functions of money, is a tool of measure, a medium of exchange, a tool to make sure you are fairly paid for your labor, and a long-term storage of value to make sure that whenever you use that money, you are fairly paid for your labor. I don't know when, because I couldn't figure this out, but they eliminated the long-term storage, and of course they did, because it's a lie. The dollar, anybody that holds dollars knows that. But now, with the advent of the CBDCs, they want to take away that being fairly paid for your labor piece and only have money considered as a tool of measure, so they know how much to pay you, and a tool of barter. But as soon as you deposit that check, or it's not even you, your check goes into the CBDC, they're instituting, or they intend to, negative rates, which means if you made $100, as soon as they deposit it, all of a sudden there's only $98 in there, or 95, or whatever that negative rate is going to be. It really is hiding in plain sight, and it shocked me. Were you aware of this, and what's your feeling on it?
Well, it really, if we take money, as you said, originally money was just representing, there was a piece of paper before it was printed in metal form, and that was just representing the underlying asset which was placed in the bank. That was money, and it was always backed by that gold, that underlying asset. Right. But so money is really from the beginning. Now, money today is also derivative.
Exactly.
Yeah. if you think about it, that's all it is. And that's because there's no intrinsic value, and even less so today, because today it doesn't represent the value that originally it was meant to be, which is actually the same as the underlying gold that was lying in the bank. And therefore, it's just a derivative. And of course, that's why it's so wonderful for the central banks now that they can derivatives, or sorry, CBDC, central bank digital money, is just another form of paper money, of course. It's nothing different. But it's also an elegant way for them, number one, to pretend that now we have a new currency system and we write off the old debt in dollars or in euros, and now we introduce a new currency in form of digital currency. But of course, people will be fooled for a very short time. But the other, of course, beauty for the authorities, governments, whatever, is that they can then fine you and tax you and turn off your money whenever they want with a switch.
It's programmable, which is, which is different than this was not programmable. You were losing your purchasing power. But you make such a good point that this is really a derivative of this.
Yeah. Exactly.
Just like what's on the market. Those traders, they're trading gold derivatives and silver derivatives and oil derivatives. They're not actually trading the real, the physical.
No, and we know that because nothing is ever delivered either. No one could deliver any of we talk about the gross value of derivatives, because people say, well, it's only, or the bankers will tell you that it's not the gross value that counts, it's the net value, because you can offset positions. But when counterparty fails, gross remains gross. And who can settle 2 quadrillion of values? It doesn't exist.
What's interesting about that? I'm pretty sure it was 2005 when they changed the bankruptcy laws and put derivatives ahead of actual vendors. Like, I'm a vendor, I sold you a product, your company went bankrupt. Now somebody that bought a contract on how good my credit was or whether or not I would go bankrupt, they're the ones that go to the head of the line and get paid out. So do you think we're going to actually see that come about? And is that a way to transfer all that wealth to the bankers or the derivative holders?
Well, I'm very clear what's going to happen at some point. Whatever games they will play before that, and whatever artificial resets that they will have, none of that will be for real, and none of it will work. If it will work, it's only for a very limited period of time, because what they're doing is just playing with the same instruments and calling them something different. So that's not going to save anything. And in my view, the inevitable consequence of all of this is that the debt we'll first have, because when the derivatives explode, they will first print a lot of money to settle these derivatives. So debt will go up dramatically, as I said, to maybe a couple of quadrillion or whatever, certainly much more than it is today at 300 trillion. And then thereafter, the debt will implode because it's worthless. It has zero value. No one is ever going to repay anything. There is no money to repay it with. And as the debt implodes, so will the assets that all this underlying debt supported. And therefore, that we will have, that's a reset that I expect. That's a disorderly reset. And we'll come down, both assets and liabilities, everything will come down to a very much lower level. And we'll have to start again at a lower level. That's good for the world, because it's only by having this implosion of debt and liabilities, it's only by having that. You can't write it off, the debt. It's impossible. You can't write off just one side of a balance sheet. If you write off the debt, the assets will also be written off, so they will all come down by the same amount. So therefore, it has to just implode, and then it's only from that level that we can show real growth again in the world. But Lynette, there is a problem with growth anywhere in the world, because it's not just the money. Now everybody will realize that you can't grow with printing money. That doesn't work. But even if we don't print money and have a sound economy, we have reached now peak energy, and all these alternative energy forms that people are shutting down, fossil fuels, etc. And as you know, nuclear power plants in many countries have also shut down, which is a very good form of alternative energy. But it takes decades to build a nuclear plant, power plant, and they're shutting all of that down. And the cost. So energy is now, we've reached peak energy, and also the cost of producing a unit of energy also requires energy, of course, and that cost is increasing dramatically, especially since all the energy that we're getting up now is more expensive to extract. So all of these climate people who believe that we should stop with all the fossil fuels, which represent 85% of all the fuel used today for the world to turn around. It's not possible. There will be no viable alternatives for decades, 50 years more, and gradually maybe we'll come with alternatives, but that will take a long time. And if we stop producing the fossil fuels or using fossil fuels in the meantime, the world will totally collapse, totally. Exactly. And the people who glue themselves to the road and stop all traffic, which is happening in Europe everywhere, they don't realize that. Everybody thinks that this is just, we've got to just produce more alternative energy. Doesn't work like that, sadly. We all wish it could, but it doesn't.
Right. I mean, they have to still build that infrastructure. It's like California wants everybody to drive electric cars on one hand, and then in the next breath they're saying, but the grid can't handle it. Right?
No.
So everybody can't be driving electric cars. And we are seeing some backpedaling, particularly in the nuclear area, aren't we? Some plants that were shutting down, they postponed shutting them down.
Yes, yeah, they have one. Marta, they have. But you take Germany, they've shut down most of the plants, but the last 2-3 they're not shutting down now.
Right. And aren't we also seeing, like in Germany, them nationalizing Russian energy parts that are still in Germany that they have access to?
Yes, they are. I mean, well, we all know the lunacy policy of Merkel and her government. But first they had the problem of letting in just too many immigrants that the country couldn't cope with, and then they outsourced all their energy to Russia.
Right.
And of course, you can't be dependent on one country, and especially since we have a world where nobody can keep peace. And of course, these sanctions that the US really initiated against Russia, I mean, they're ludicrous too, totally ludicrous. And the whole Western world is suffering, and the whole developing world, everybody's suffering because of that. And one thing in Roman times, the countries prospered, and countries that were occupied by Roman and every country prospered because there was free trade. So the Romans didn't stop free trade just because they conquered half, a big part of Europe and part of the East and Africa, etc. They didn't stop trade. Trade continued, and there was glorious times until, of course, the empire collapsed around, just before year 500. But nevertheless.
Currency. Right? They debased the currency.
Yeah, exactly. So there was trade, and now the US has told the world and the Western world and the EU to sanction everyone, and I don't understand why the EU agreed to, because they're totally energy dependent on Russia. So the EU has shot itself in the foot, and especially Germany, of course. And it's a disaster for Europe now, this. And especially for Germany. I mean, the other countries were weak already. All of the Mediterranean countries were on the verge of collapse before that, and Germany was a strong country. Now Germany is suffering dramatically and will not recover for this for a long time, in my view. So we are, it's interesting, as why you started by talking about Switzerland and the UK and the banking systems that are being under attack. But all the dominance are falling in all areas. But this is exactly what we would have expected, Lynette, when you get to an end of an era. That's exactly everything that goes wrong, can go wrong, will go wrong, and it is happening. And then you add war to that also, because it's always a war of these troubled times, unfortunately.
Absolutely. And that makes me wonder, I mean, really, because you brought up such a good point about, why did the EU go along with the energy sanctions when they were so dependent on Russia? And I mean, you also made an absolutely accurate statement. And during these currency regime shifts, these major shifts that we're making, there's always a war. And that makes me wonder if this is planned or it really is them and us. Do you have an opinion on that?
Well, I read a lot about it and I have a lot of knowledge about it, but I don't really like talking about conspiracy theories, because that then, some people will love to hear it and others will hate to hear it.
Oh, I didn't even think of that as a conspiracy theory. I'm just looking at it and going, there's so much insanity on both sides. I'm not making a statement. I'm just asking that question.
No, but it's very clear to the ones who also study, for example, this war. This war has nothing to do with Ukraine. This war has to do with Russia, United States against Russia, and United States, first of all, wanting to separate Germany from Russia and that relationship and dependence, because the United States didn't want a strong axis in Europe and Russia, and then going on to China. So that's one side of it. So it's really, I've learned in life that you should never. There was a book I read many years ago, which is an expression that we all know in various forms, is that before you judge somebody, you must walk 3 moon laps in his moccasins. This is an old Indian saying, but it's like wearing somebody's hat, of course. So, and you must think, I can wear Putin's moccasins. Doesn't mean that I agree with war and I agree with what he does, but, it was very clear that there was this Minsk agreement in 2014 that was brokered by Germany and France, that basically said that the Donbas region in Ukraine, which is consists of almost exclusively Russians, should have free elections. But Ukraine continued to bomb that region, and then even more intensively just before the Russians came into the country. And some people say that there was a deliberate move by the United States to tell Ukraine to bomb in order to escalate the war. I don't know. I mean, no one can prove that. I don't know. What I'm saying is, it was at least clear that this Minsk agreement should have been settled, and the Donbas region, which this war is all about, because that's what Putin wanted. That's why he invaded. He didn't invade to take Ukraine, just for the Donbas region to have these free elections and decide. Since they're 100% Russian, more or less, they probably would have gone with Russia. And that's what started this war. So yes, of course, there are other things behind, a lot of things that we are not aware of. Yeah.
It's a really good point on that. And then you look at what's happening with China and Taiwan. Do you think we're headed for World War III?
You know what? It's a good question. That first of all, some people are worried about war in Europe, and some Americans are afraid of coming to Europe because there's a war. There isn't a war in Europe. There are economic problems, certainly, but there's no war in Europe. There is a local war in Ukraine. Russia has so far in history virtually never gone west. They only chased the Germans out of Russia in the Second World War to Berlin, but that was just to get the Germans out. Otherwise, they've never invaded the West, and they have no interest in doing that. Yes, they have gone east a lot, but they consider part of their territory, because that was the former Russia, the former Soviet Union. So I have no fear whatsoever of a war in Europe. And no country wants a war on the ground, because nobody can win a war on the ground. Therefore, the only war that would be is a nuclear war, if there was one. Of course, the risk is there, because anybody can press that button by mistake, because they suspect somebody else having pressed it, and they press it. I mean, that's the big danger. But I don't worry about that either, because if we get a nuclear war, we're all dead. and we're all going to die anyway. My philosophy is we're all going to die anyway. So of course you want your children or grandchildren to survive, but so I cannot go and worry about a war, because a war which is likely to kill the whole world, like in Neville Shute's book and film On the Beach, that's frightening and horrible. But nevertheless, I don't worry a slight bit about that, and I'm not afraid of a war on the ground in Europe, for example. I think that war will remain local to Ukraine. It could touch Belarus or whatever, but they're not going to go further into Europe at all. And if there is a risk of a war on a bigger scale, there's only a nuclear war, and that's nothing. I never worry about things I can't do anything about.
That's true, but not all wars are played on the ground. And what we've witnessed with this war is the weaponization. We've seen this before, though. The weaponization of finance and the weaponization of energy. And, the finance piece also means that food is now weaponized. So, ground wars, that's like history. And I think that's more about show. I think that we could be seeing a World War III on ever so many levels, as countries weaponize the biggest assets that they have. In fact, some are actually arguing that that's what's happening with the dollar, is being weaponized. So it's such a strong dollar, and apparently nobody here particularly cares about the impact that strong dollar is having against the rest of the world. But, and certainly, of course, hey, I'd much rather I'm being facetious for viewers, but, after all, you would much rather have a treasury bond and the fragility in those markets than you would a piece of gold that has the broadest base of buyer. So can you address the strong dollar and that whole piece behind, the fallacy?
I simplify the strong dollar. Of course, since the introduction of the petrodollar, the dollar became the reserve currency and the payment currency of the world, which everybody had to have. Number one, for energy, and since it was used for energy, it was used for basically every commercial transaction between parties around the world in trading, even outside of even where the US wasn't involved. Mm-hmm. So that was a very clever way for the US to actually dominate the world with the currency rather than with weapons only. So that was basically a build-up of a financial empire, which has benefited the US tremendously, but at a cost. And the cost is that, well, as we know from the US debt, federal debt has gone up virtually every year with a 5 years exception since 1930.
Why not?
Number one. Yeah. And as I said, since in 71, when they closed the gold window, the US dollar has lost 98%. So the US is bankrupt, living above its means, but it still has an instrument or a weapon with which it can dominate the world. But, since we've seen all currencies decline by 97 to 99% since 1971, Lynette, the dollar is just temporarily slightly stronger than the others, because this is a game of stair stepping, and they can't all go down. The currencies can't all go down against each other at the same time.
Right.
And just now, recently, in the last few years, the dollar has been stronger. That's temporary. They will continue this game of the dollar will be probably next to fall. Now, some people say that with now the financial system under pressure and Europe having problems and assets and with the political problems in the world and potential wars, that assets will flee to the dollar. Maybe they will a bit more for a while, but the dollar to me looks very overbought. It's as I said, it's a currency which from a country which is totally bankrupt, both debt-wise and balance of trade, balance of payment-wise, etc., and living above its means for at least 50 years and even 90 years if you take the federal deficit. So therefore, the dollar will collapse too. I mean, so it's a temporary thing, and I certainly wouldn't hold any currency. If you're going to play the currencies, you will lose always. Because no individual has the ability to switch from currency to currency. And therefore, why not just hold the currency that has never gone down ever in history over time? I mean, it's so easy. And we are being supported every day, Lynette, by central banks. When I say we who understand money and gold, every day the banks are spending billions and trillions in supporting gold's value by constantly debasing their own currencies. I think we can ignore the fact that the dollar temporarily strong and gold therefore is temporarily weaker in dollars.
That's a contract too. That's just a derivative contract.
Yeah, exactly.
Right?
Yeah. So therefore, it's so easy. If you want to sleep at night and not worry about investments, but sadly only 0.5% of world financial assets are not into the one security, if you want, or currency, which is always over time has survived and maintained its value, and which is gold. It's so simple. And as I said, now with the increasing amount of inflation, money printing, and debt default, you will have more and more money printed in every country, in every currency, and the fact that gold has been standing still for a while in dollars means nothing. It's up 7-8 times in euros, in yens, in yen, in pound, etc., since 2000. It's just up only 6.5 times in dollars or something like that. So the dollar isn't strong at all. It's just temporarily a little bit stronger than the other currencies. And no one, it's just that, yes. So therefore gold looks weak, measured in dollar terms. Well, we hear, and nobody measures gold in dollar terms. Do you think the Japanese have seen the yen collapse? Do you think they measure it in dollars? They measure it in yen. And the yen has collapsed against gold. And it's the same with the pound, the same with the Swedish krona, etc. So, and the time for the gold against dollar is going to come very soon also.
Yeah.
So therefore, it doesn't worry me. I'm not worried about these artificial temporary moves, which I call this, because I can't, there's no use playing that game anyway.
Right. But there's something also that's really, that I'm seeing, so I'm wondering if you're seeing this too, in the physical market, because you rightly were talking about derivatives, and what is the spot gold contract is a derivative. It's just a contract. They can create as much as they want to. But I'm seeing premiums now in the physical market, like in China, they're at the highest level, at least in the last two. The premiums are at least the last two crises, the premiums are now higher than that. And I also saw a breakout in like the lower quality collectibles, as well as and a huge breakout in the very high end. So what are you seeing, because you deal with massive volume? So are you
Yeah.
what are you seeing in your markets?
Yeah, there are two different markets now, really. There is the retail market, the smaller investors, and especially we talk about here coins, and maybe small bars, and there and also of course silver also.
Yeah.
There we're seeing. Yes, so that's not our market, but I'm just saying I know just like you that that market has got massive premiums now.
Right.
And but if you deal in the bigger bars and in the wholesale market for bigger investors, gold demand. So in the smaller market, high premiums, high demand. In the bigger market, bigger investors for bigger gold bars, silver bars, their low demand is right now quiet,
Wow.
and premiums are not high at all.
That's
So you have
interesting.
yeah. So it's a two-tier
Interesting.
market right now, except for the paper market, of course. So that's interesting. But you know, price is telling you that. You're talking about massive margins, etc., massive spreads on gold and for coins, etc. But look at the price is not moving at all. So that
Exactly. Well,
market,
the
which has
spot.
high demand, is not moving the gold price or the paper price, which is mainly the gold price anyway. So therefore, there is no shortage at that end of the market of gold. Yes, there is steady demand. There's always been. The refiners are as always selling everything they produce. And you know, the 3,000 tons that are being mined every year of gold is all being sold, which it always has been. But there is no excess demand now in the big market at all. So
That's
that's still to come.
But you know how interesting that is? Because when I'm looking at the ultra rarities, which is kind of, this is I guess, a two-tone market. But the ultra rarities, the breakout has been like actually very substantial. And these coins will, I mean, they are still coins, so they are still retail, but these might go for, 8 million, 15 million for an ounce. So I'm
Yeah,
sure that the bigger market is going to absolutely catch up with that, because
I
that's the
will.
smart money.
I don't think we are. I mean, I've learned patience, so there's no use trying
Yes.
to time it in the short term. But I
Yes.
think when gold breaks out here now, it's going to go very fast, in my view, because the
Hmm.
underlying fundamentals in the world are so strong, and gold has not. And I'm talking about in dollars now, because in other currencies, gold has been strong already and is strong. Uh, uh, but gold has not yet reflected the enormous amounts of money that has been created and printed in the
Yeah.
last few years. So plus there will be a shift, Lynette. Investors, once they realize that stock markets are going to continue down and bond markets are going to continue to be weak, and they have to go away from the 60-40, 60% stocks and the 40%
Yes.
bonds, like
Hmm.
every average investment portfolio, and especially pension funds have.
Hmm.
And they have to realize that they have to include some part of inflation protection in this. Of course, the world is not going to put all their money into gold, because there is no gold available for that at all.
Right.
But if they go from 0.5% to 1% or 2% of world financial assets, gold will explode, because there isn't enough gold in quantities to satisfy that, so they can only be satisfied by a higher price, and that's going to happen, definitely. And I don't think we're far away from it. So and as we always say, buy your insurance before the house burns. Get
Right.
it now. Don't worry about it. Just and don't worry about the daily value of it. Just have it and have
Right.
it ready. Uh,
What are you going to do? Convert it into this garbage? I mean,
yeah.
the really wise words. And I could go on and on, because there's so much happening in this world. But I want to respect your time, because you are over in beautiful Switzerland. So I know that I really appreciate your late interview. I really do appreciate it a lot, Egon. Are there any other words of wisdom, and you want to tell people how they can find you? Of course, we'll have all the links below and also on the blog, but anything that you
Yes.
feel.
Yes, of course. Well, thank you for those words, first of all, because yes, I think it's always very special to speak to you because we're speaking the same language. We're trying to help a number of people. We don't run businesses. This is a passion.
Yes.
Helping a few people, and sadly only a few, because most people don't understand this and don't believe in it. But we're helping a few people to save and to protect their wealth at whatever level. That can be at the 1 ounce or 1 gram or level, or it can be at a 100 kilo or a ton level. Doesn't matter. The principle is exactly the same. And if people in Venezuela, for example, 10 or 20 years ago had just bought a gram of gold or an ounce of gold, they could have paid for all their food now, etc., for a long time. So it's important at whatever level you are to protect your assets. So we do it for bigger investors. So we have one vault where the minimum is $400,000, and then we have the biggest private gold vault in the world in the Swiss Alps, which is a James Bond-like experience. It's the protection that doesn't exist in any other vault in the world, and that our minimum is $5 million. So it's for much bigger investors. But as I said, the principle is the same whether you buy an ounce or whether you buy a ton of gold. The principle is the same. The protection now is absolutely critical in the times that we expect coming, and that doesn't include, a war is in addition to that. We talk about the economic and financial collapse that we are likely to see. So but the otherwise, you and I often talk about that. It's all about now. We see it already. People suffering everywhere. We see it in Europe, in many countries. People haven't got money for heating. A lot of people are turning heating off now. They can't buy enough food. They go hungry. And this is normal people. This is not poor people living in the street. But that's going to happen too. So it's already starting everywhere, and it's going to get worse. And of course, what we have to do, to the extent we can, or everybody has to do, is to help fellow human beings. You help friends and family and whoever you can help, of course. And that's key now, because there are going to be a lot of people who are going to suffer very badly in these coming times.
Yeah, probably you've got to have food, water, energy, security, barterability, wealth preservation, and shelter. But arguably the most important piece is that community piece that you just brought up. So thank you for bringing that up, because I couldn't agree with you more. Mm-hmm. And I am so happy to have you here today. And I promise one of these days I'm going to let you show me your big vault.
Absolutely.
I'd love to see it. I'm sure everybody would love to.
Absolutely. Yes. Please come. Please.
Well, I'm going to plan a trip. I'm going to. It's very interesting times to be gone these days, but I'll figure it out.
You're always welcome.
Thank you. So as you can see, I hope you guys we covered a lot of really important topics and things that are having an impact on all of us, and also on precious metals, which is the primary currency metal, silver, the secondary currency metal. But the reality is all of the fiat currencies, all the government currencies, they're going to their intrinsic value of zero. So I hope you got a lot out of today's interview. And until next we meet, please be safe out there. Bye-bye.